For the enterprises, China accounted for 12% of revenues generated in Europe and 15% of overall revenue in the US. A Chinese economic downturn might therefore have an impact on capital markets outside of the Asia-Pacific and developing markets, which could have an adverse wealth effect on consumers and private consumption in the US and Europe. We find that household asset values in Germany, France, Italy, and Spain total up to 28%, 28%, 40%, 40%, and up to 55% respectively of securities, primarily equities. China's economy has experienced decades of double-digit growth because of its inexpensive machinery, technology, and consumer items exports. Due to changes in domestic consumption, China's economy, which has been the most significant and fastest growing in the world for the past few years, is slowing down. It's added $23.01 trillion, or 18.3%, to the global gross domestic output of $125.65 trillion in 2020. Because of this, any slowdown in China's economy impacts the world. Because of the global COVID-19 epidemic, China's economy has fallen from 10.6% growth in 2010 to 2.3% growth in 2020. China still outperforms other major countries despite this sharp slowdown. A Chinese economic collapse may first impact the rest of the world through trade. A decrease in Chinese demand could decrease exports from other countries, as China is an important trading partner for many nations. Higher unemployment and slower economic growth may follow from this. A second way a Chinese economic collapse can impact the rest of the world is through investments. Given that China has recently been a substantial source of foreign investment, a drop in Chinese investment could lead to a decline in other countries' assets. Higher unemployment and slower economic growth may follow from this. Let's discuss some of the reasons for slowing down China's economic growth. Why China's economy is slowing down. The two main drivers of China's economic downturn are the US-China trade war and a deliberate shift by Chinese officials. The global supply perspective. In terms of global supply, the downturn in China's economy could increase trade costs and prolong delivery delays. The electricity rationing policies mainly cause an increase in production costs. It will increase the cost of items exported by China to the rest of the globe and may pressure company margins, particularly in Europe. Additional COVID-19 breakouts in China could increase already lengthy supply chain bottlenecks. Furthermore, we do not anticipate a significant devaluation of the CNY that might offset these increasing price pressures. Aside from its impact on prices, China's sluggish production and commercial activity could aggravate production shortage problems in the US and Europe. Global demand perspective. The economic downturn would harm exporters to China, emerging markets, and some commodity prices from the standpoint of global demand. A slower China would negatively impact most emerging economies, the Asia-Pacific region, and several commodity exporters. We discovered that countries with the highest risk potential are Australia, South Africa, Hong Kong, Chile, and Peru, whose GDP are more than 2% of their exports to China in the metals and construction sectors. On the other hand, because of China's persistent energy problems, exporters of energy, particularly thermal coal, especially those in Indonesia, Malaysia, and Australia in the Asia-Pacific, are anticipated to experience an increase in demand. Further than the short to medium term, nations reliant on Chinese demand will have to manage risks associated with the nation's shift to a poor growth regime, which began before COVID-19. Our potential growth model predicts that China's GDP will rise by 3.8% to 4.9% on average during the next 10 years, down from 7.6% in the 2010s. Long-term exposures for exporters may change as a result of China's shifting economic structure, with those dependent on consumption and high-tech goods perhaps benefiting, and those dependent on heavy industries and construction potentially losing out. Financial markets perspective. From the viewpoint of the financial markets, the slowdown in the Chinese economy may have an impact on other stocks, potentially detrimental to consumer wealth. The stock market in the rest of the world has historically been affected by concerns about the Chinese economy or any actual downturn. This link makes sense when looking at equity indices, since most of the constituent companies' sales are made directly in China. More specifically, the reports showed the sales in China around 75 S&P 500 index firms, representing 20% of the entire capitalization, and more than 100 Stocks Europe 60 index companies, representing 30% of the total capitalization in 2020. Could stress factors on the Chinese capital markets affect other countries' markets? Chinese international corporate bonds are more susceptible to risk, whereas stocks are more likely to experience sentiment contagion to other markets than corporate credit. However, a contagion is more likely in both asset classes in the case of a significant decline in performance in China. Due to recent market pressure on China's corporate bonds, we anticipate more short-term collapses among risky real estate developers, particularly concerning bonds issued abroad. For example, those denominated in foreign currencies. The high-yield real estate market expectations and the valuations of hazardous real estate developers remain the only areas of concern. In the MSCI EM and JPM CEMBI indices, the weight of the Chinese market for real estate as a whole is only around 2%. Let's discuss the impact on the corporate bond market. Corporate bond markets. Looking at the pattern of spillover effects in this region, we find that before 2015, the most impacted areas were the US, Asia, and the Eurozone by the Chinese markets, then by the Eurozone, the US, and other emerging economies. The EM credit space had spillover effects from Chinese credit during the 2015 meltdown, whereas China was less affected by the US and Eurozone markets. In other words, given all other factors being equal, the negative 1% decline in Chinese debt bonds in 2015 reduced EM credit by negative 11 basis points. The US and China's economic connection is quite synergistic. Between 2017 and 2019, China's economy slowed down partly because of a trade conflict with the United States. Trade, debt, and the dollar price will all be impacted by the downturn in China for the United States. The US and China are each other's top trading partners. In 2020, American businesses sent $124 billion worth of goods to China. If China's economy weakens, so will China's demand for American products like food, cars, and commercial planes. China supplied the United States with $434.7 billion in 2020, mostly electronics, clothing, toys, and telephones. The difference between American exports and imports from China, which is $310 billion, is enormous. As a result, China is where the US has the most significant trade deficit. Many American manufacturers who export their raw materials to China do so that the products can be completed more cheaply. They're regarded as imports once they're delivered back to the US. Because of this, many American businesses indirectly gain from the trade deficit. It's worth considering that China's influence on the global economy is expanding. It ranks as the 10th major exporter and has one of the fastest growing economies in the world. China is a large borrower in the global financial markets and is a substantial recipient of foreign aid. It's luring enormous amounts of direct foreign investment, including more than $11 billion in 1992 alone. It means that any downturn in China's economy would have devastating impact on the global economy. China's expanding economy is a significant factor in global demand, and its economic reform will open up new markets for exporters of manufactured goods. Still, in the medium term, it could result in a decline in demand for commodities. China's impact on other developing nations' economies through trade, investment, and ideas is expanding. Thanks for watching. Like, share, comment, and subscribe for more knowledgeable content.